Morning, everyone. Thank you all for coming. I'd like to think that you were here to see me speak, but I know the real reason you're all here today is because of that luxurious invitation that you all received in the mail. And I'm sure many of you are, saddened when you opened it and didn't find an iPhone. I know I was. I actually expected something better than a little tag with my name on it, but that's why we're here today. So today I'm here to talk about how to make people money. And how do I specifically make people money? I think that was a very good intro. I do run money differently than just about anybody else in the country. I would argue just about anyone else anywhere. So I want to walk through how that happens. So I crafted this little icon in about 4 minutes in my office, and I've used it ever since, now for 10 years. And I like to call it positive change. But really, it's any sort of change. It could be positive or negative. But what I focus on is change. What is changing? Why is it changing? How is it changing? How durable is that change? This is the art of investing. This is not the science. This boils down to experience and paying attention to all the different fundamentals that you can see every single day. And this is what I spend my time on. This tends to lead me to parts of the market where others fear to tread. And I believe this is really the source of my continuing alpha in both of my funds. So for the students in the room, I'm going to tell you something that you really should not hear, and your professors would fail you if you ever write this on an exam. The middle of this graph shows where everybody invests. So when you go to school, they teach you all these great things, about competitive positions of companies and how the market is efficient, and we need to own good companies with barriers to entry, and there's the Porter 5 Forces model, and all this baloney. You're not going to make money doing any of that. None of that. None of that is going to let you make money unless you are a super genius, and we have some of those people today, and you will talk to them. I am not a super genius. I cannot compete with the folks that can invest with all of that traditional, plain vanilla investing knowledge. I invest where things change quickly. Rapid change, either positively or negatively. And that tends to push me into the weeds, right? To use a golfing metaphor, I am always in the rough. I play where there's high valuation, high expectation stocks that scare investors to death. I also play in low valuation, no expectation stocks where investors are scared to death. If you play in these parts of the market, you do not have to compete with all the very smart people who went to smart business schools and got A's in their finance classes from the smart professors. All right? That is not how I make money. Paying attention to fundamentals is the key variable for me. I cast a very wide net. I am continuously looking at news. I read voraciously. I have 500 different periodicals stacked high on my desk, and I do get through them. Not every day, but I get through them. And how I do this is just massive, wide funnel of information. So let's walk through some of these things. What do I mean by high valuation, high expectation names? So I put down a few of the examples that are currently in my portfolio. Shopify is one, NVIDIA is one, Kinaxis is one. What do all of these companies have in common? They are expensive, classically expensive. They are in the, I am going to throw this stock away, it is so expensive category for most investors. But what they're also doing is they are revolutionizing their respective industries. They are making things change. And it is very hard to encapsulate change in any sort of investment framework where you use some sort of model invented by a professor somewhere, right? How do you encapsulate what Shopify is doing to industries in terms of how people shop and the value that they're adding to small businesses all over the world? How do you encapsulate what NVIDIA is doing in terms of artificial intelligence and the move towards, connected cars and bots that talk to you? You can't, right? You cannot just say, well, this is worth this, and this is worth that, and this is worth this. That doesn't work. What you have to focus on is change. Is it getting better? How is it getting better? And you know what? If you own stocks where things are getting better, they often continue to get better at an accelerating rate and go so far beyond where you expected them to go that you cannot believe it. I think I bought Kinaxis at $9. It sounded like a decent little company in Ottawa. They were doing some interesting things in supply chain management. The stock just took off. It just keeps getting better. And the key also to when things are getting better is you don't sell too soon. It's so hard to find good stocks that outperform the market. Many people say, oh, I made 50%, I'm out. Oh, I made 100%, I'm out. You don't make money doing that. When you've made a 10-bagger on a stock, maybe you start to think about getting out. When things are getting better, stick with it and own it and ride it. And your professors will fail you for that every single time. So the next one, low valuation, no expectation stocks. I basically put this in as a sort of an industry. I show all the different industries that I have made money in over the years. And you can see it goes all the way back to 2000. In 2000, I covered mining stocks. And I can remember they almost fired me because I said mining stocks are a buy and the Chinese are going to be important. And I can remember being called into an office and saying, you're stupid. It was actually a very good call. We made a ton of money. You sometimes have to go to places where nobody else wants to be. And sometimes that really makes you buy companies that are terrible. And yes, you will make mistakes. These things turn into value traps very quickly, which is why you have to continually sort of figure out what the fundamentals are saying to you. So all of these different sectors, I have made tons of money in every one of these. Housing, metals, fertilizer, solar, energy and gold last year, lumber. At one point, I owned every lumber stock in Canada. Sometimes the worst stocks are the best stocks. And I have a few in my portfolio today, I'm sure we can get to in Q&A, which are terrible. Terrible companies in terrible businesses that have no competitive advantage, have terrible returns on capital, terrible management, and they are great stocks. You know, it's true. This is how you make money. We're not here about, how to get things right and how smart I am. It's about how do I make money? And I make money by owning stuff that nobody else wants to own, and things change. Change is crucial. So the next slide is what I call the sell discipline. And I've cut this down because I have to be quicker today. I'm only showing one chart. When you play in the tails of the market, where it is difficult and things change very quickly, the first thing that comes to people's mind is, well, that sounds like it could be a little bit risky. Every time I say the word risk, they make me put $1 in the risk jar. So I now said it 3 times, that's $3. Risk is something you can control if you are very quick to sell. And I am a very, very good seller. We have quantified it internally, and they have told me I am the best seller at Fidelity. I do not take the big loss. This is an example. This is Nico Resources, it was a fraud of a natural gas company that was drilling for natural gas in the oceans around India. It was going to be awesome. It had a huge valuation. And guess what? They didn't find any gas. The trick was to get on that early, to figure out early, this doesn't feel right. What are the triggers? Management's uncomfortable. The answers they give you don't make sense. The news isn't really lining up with what they say. Stocks start to drift down. You don't have to be a genius. Nobody gets out at the top, right? If they told you they got out at the top, they're lying to you. But if you pay attention, you can get out relatively quickly. So maybe you take that first 20% loss. On this slide, you can see where I sold every single share. I think I owned 8% of the company. I sold it all in one day. I made the stock go down 20% in one day. But guess what? That stock went from 80 to 0. 0. So I sold it from 100 to 80, I took a 20% loss, but I saved myself enormous pain. These are the stocks that ruin your portfolios. If you own too many of these, you will lose. And I never own this stuff, right? If I am selling a name, please don't be buying it. If you hear I'm selling it, don't buy it, because it's going to look like this. I have a lot of charts that look like this. I am very, very quick to sell. And by being quick to sell and being vicious with the selling, that allows you to protect on the downside, which is one of the things that at Fidelity we like to talk about a lot. So let's look at protecting on the downside. This is Canadian Growth Company over the last 5 years. Now, I would like to point out the last 5 years have been amazing for me, and likely this doesn't continue. That's a ridiculous number, 116 up, 29% down. This is relative to the TSX. That is a ridiculous number, 11% excess return. So what this number tells you, for those of you in school, is in up markets, I'm beating, and in down markets, I'm beating, which is like the perfect mutual fund, all right? That's exactly what everyone should have in their portfolios because it means you win in both markets and your clients don't call you and yell at you, all right? A better number is the next chart. This is special situations where I'm coming up on my 10-year. And honest to God, I never thought I would survive 10 years. And no one else did either with my crazy style. This fund includes the Great Recession, right? Remember that? I managed money through that. It was awful. I did not sleep. I was up at 2 in the morning. I was trading in Japan. I had Indonesian stocks. I managed through that period of time. And look at the numbers. Upside, downside, in special situations, including the worst recession we have ever had. If you just owned the fund for the full 10 years, it's 1 in up markets, it's 1 in down markets, it's giving you 11% excess return. That is better than any ETF you're going to find, certainly better than any index you're going to find. And I do it the same way I have always done it. My style has never changed. It does not change in any market, up or down. If fundamentals get worse, I get out. If fundamentals get better, I get in. I am always looking. That's the number of rocks you turn over and the quality of the rocks you turn over is what matters. That's the Fidelity edge. That's how we win. We have better information than anyone else. We know what to do with that information, which is super important, right? That's experience, knowing what pieces to play when you see them in the markets. Very, very important stuff. That cannot be taught. That has to be learned. And you only learn that by getting beaten around by the market for years on end. So I feel like I can say that. I've been doing it for 20 years. I've been beaten up a lot. And that's it. It's a very simple message. I really love this quote. Professor Google found it for me. Took me 3 minutes. I immediately said, this is me. But it's very important. You have to continue to change. You're always trying to improve. I'm always trying to improve. And that's the core of what I do.